Good morning, guys, to you both. Michael, love first for you to just kind of weigh in on what your outlook is for the Fed, just how much you feel as if what we've seen from inflation and what we've heard from St. Louis Fed President Jim Bullard has altered your view about just how aggressive the tightening might be this year.
Sure. Well, first of all, thank you for having me on. We certainly think the Fed is not in the mood to skip a meeting, so we think that they will take a succession of policy actions here. We think they've raised the funds rate 25 basis points at each of the March, May, and June meetings. We think they announced balance sheet runoff at the June meeting. So it does seem like they need to get going, and I think front-loading a policy response makes a lot of sense to me and from my perspective. I don't think a 50 basis point hike is needed. Certainly the market has opened the door for that, and the committee will debate whether or not they should walk through it. But I think that's probably too aggressive and may be a little viewed as a little panicky at this point. So I think they need to get moving and they need to be regular. I just don't think they need to come out of the gate with the large 50 basis point increase.
And obviously we're going to get more numbers before there is a meeting, a policy meeting. But do you think that the way the market is positioned right now, Michael, makes it tough for them to just kind of leave the uncertainty out there in terms of just how many hikes they might be looking at?
Absolutely. I think the Fed historically will surprise on cuts, but they don't like to surprise on hikes. So if the market is pricing in 50 and the Fed does not want to do that, then I do think that they need to come out and message a bit here and kind of guide market expectations. So yes, if I were the Fed and I thought I'm going to be moving 25 basis points in March, I would not be happy with where pricing is, and I'd try and walk that back a bit.
Phil, I want to get your thoughts on this. What do you think the Fed does over coming months? How aggressive are they? What does this mean for markets?
Yeah, good morning, and thanks for having me. So speaking of panicky, the traditional balance fund is broken right now. You have the S&P down about 3, and the core bond index, the Bloomberg aggregate, down 4, right? So this is a time where that just creates chaos and kind of deer in headlights for folks. Couple of things, though. This is not a growth scare, okay? I think if you see things like banks and airlines and cruise lines and energy and materials doing well, that's a pretty good sign. Also, I would agree with Michael's point. There's a reason why the Fed hasn't done a 50 basis point hike in over 20 years. It's because they tend to move very, very slowly on the way up, so up in an escalator and down an elevator. And I remember October of 2018 when the same chair, Powell, said we're far away from our neutral rate, and he sounded very, very hawkish. They did one hike after that and paused in January, and we're easing by July. Now, that being said, we don't expect that. With the data the Fed has right now, we think that they'll take the option of having 6 rate hikes priced in, but it's about being active here. So Morgan, I think that the answer is reduce your stock overweight, but stay overweight because the fundamental story is still strong, and really look for the earnings. I think that's really what we're trying to do with active stock picking. But because the range of outcomes have increased by so much on the monetary policy side, just take a little risk in our opinion.
Okay. U.S. still the place to be, though, in terms of how investors are positioned, or are you looking elsewhere?
Yeah, so Morgan, it's been 14 years in a row. I've been on your show talking about global diversification for a long time. And at this point, we're very, very close to a neutral on the U.S. And I think that's, in a way, an ode to 2 things. One, the fact that non-U.S. investing makes sense from a fundamental standpoint right now. It is awesome that the ECB is talking about raising rates. There's a lot of people that thought negative interest rate policy was a bad idea, and now they get the chance with a 4% inflation rate to try to get out of that. So out of the U.S. and into developed non-U.S., and guess what? There's one central bank that's not worried about inflation, which is China. They're easing, and emerging market equities are up 1%, and we're neutral emerging markets. So we've taken down the U.S. in favor of non-U.S. markets, which is certainly working this year.